Hello and welcome to the Valuation Desk by Highland Global. I'm thrilled to talk about a topic that sparks confusion in SBA 7A business acquisition lending. Goodwill. Many lenders think, this business has a great reputation and loyal customers, it must have goodwill. But in fair market value valuations, goodwill isn't about warm feelings or history, it's about cash flow. If there's no cash flow, there's often no goodwill, no matter how beloved the business is. Let's dive into what goodwill means, how it's calculated, and why it matters for SBA 7A loans. What is goodwill? Goodwill is the value of a business above the fair market value of its net tangible assets, things like equipment and inventory. It captures intangibles such as brand recognition, customer relationships, a skilled workforce, or favorable contracts. The formula is simple. Goodwill equals enterprise value minus net tangible assets. For example, a business valued at $1 million based on capitalized cash flow has $800,000 in tangible assets, inventory, receivables, and cash. The intangible value or goodwill is $200,000 driven by its earnings. Goodwill typically exists when a business generates excess cash flow beyond what its physical assets alone would produce. Under the SBA SOP, goodwill gets close scrutiny. If the business acquisition exceeds $250,000, or there's a close relationship between buyer and seller, a qualified valuation is required. That valuation must use fair market value, not emotional attachment, strategic value, or we've always been here value. Goodwill must be backed by the business's future earnings potential. If a business has negative cash flow and relies only on tangible assets, like in a liquidation scenario, goodwill is typically zero, no matter how long it's been around. Let's talk about a real example. Consider a 30-year-old pest control company with a strong brand, 500 customer contracts, and loyal staff. Sounds like goodwill, right? But it's losing money, with negative cash flow and operating losses. Here's what happened in the valuation. The income approach showed zero value, no cash flow to capitalize. The market approach didn't apply, no profitable comparables. The adjusted book value method valued only tangible assets like vehicles minus liabilities. Result? Zero goodwill. Lenders were shocked. How can there be no goodwill with all that history? But without transferable cash flow, those intangibles have no economic value under the fair market value standard. Let's tackle some common lender misconceptions. First, a 30-year-old business must have goodwill. History matters only if it generates profit. Otherwise, it's just nostalgia. Second, those 500 contracts are worth something, only if they're transferable and produce earnings, which they didn't here. Third, everyone knows their name. Name recognition needs to drive cash flow to count. Appraisers aren't ignoring the business's story. They're following the economics as the SBA requires. Here's what SBA 7A lenders need to know. Goodwill isn't automatic. It must come from sustainable, transferable cash flow. Unprofitable businesses often have zero goodwill. The fair market value standard prioritizes earnings over reputation. When appraisers assign zero goodwill, it's not a slight, it's economic reality. Goodwill isn't about good vibes, it's about cash flow. Ask appraisers how they calculated goodwill. Ensure it's backed by sustainable earnings, not just history or contracts. That keeps the valuation solid and loan sound. Thanks for joining us for this episode of the Valuation Desk. For more information on goodwill and other valuation-related topics, be sure to visit our website, highlandglobal.com. Lenders know experience matters most.